Hey everyone, welcome back to Corporate Decoder. Today, SmartStop Self Storage REIT Incorporated SMAR just filed an 8, and I'm seeing a key metric that shows a potential slowdown. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is sharing some operational numbers for May, and while things are still solid, one key figure is heading in the wrong direction. So SmartStop Self Storage, or SMAR as it is traded on the New York Stock Exchange, has put out some important operational information. This filing is a current report, which means it is for really significant events that shareholders need to know about right away. It covers periods up to the 2nd of June 2026. Now, SmartStop is in the self-storage business, and they're structured as a real estate investment trust, or REIT. This means they own, operate, and often develop income. Producing real estate, people often invest in REITs for their dividends, which are typically higher than other types of stocks. Their common stock trades under the symbol SMA on the New York Stock Exchange. This section is all about Regulation FD Disclosure, which basically means they're providing information to the public at the same time to ensure everyone has the same access to important details. They're sharing metrics for their same store facilities. These are properties that have been consistently part of their operating results, helping us see how their core business is performing over time. They're excluding a few other properties from this particular set of numbers. So we're looking at a stable, comparable group. Let's dive into the numbers. First up, physical occupancy. As of May 31, 2026, their facilities were 92.4% full. That is down slightly from 93.1% the year before, on May 31, 2025. A 0.7% drop might not sound like much, but in the space business, every percentage point of occupancy really matters. Lower occupancy means less revenue from rent. Next, we look at monthly web rates. This is essentially the advertised price online. As of May 31, 2026, this rate was $1.21 per square foot. This is also a slight decrease from $1.24 in May of the previous year. So not only are they a little less full, but the advertised prices are also ticking down a bit. Then we have monthly move in rates, which is the price customers actually pay when they first rent a unit. This has seen a more noticeable drop, falling from $1.12 per square foot in May 2025 to $1.06 in May 2026. This suggests they might be offering discounts to attract new customers, or there is increased competition pushing prices down. However, there is a bit of a bright spot here. The monthly in-place rates, which represent the average rate for all occupied units, have actually gone up from $1.63 per square foot in May 2025 to $1.66 in May 2026. This means that while new customers might be getting lower rates, the company is successfully increasing prices for its existing long-term tenants. This helps offset some of the decline in occupancy and new move in rates. So to summarize the key operational metrics, occupancy is slightly down. Advertised rates are slightly down. The rates for new customers are down more noticeably. But rates for existing customers are up. This paints a picture of a self-storage market that is becoming a bit more competitive, potentially forcing SmartStop to offer incentives to fill empty spaces. Now, looking at these results more broadly, SmartStop Self Storage is operating in a sector that has seen significant growth over the past decade, driven by factors like smaller living spaces and increased demand for storage during life transitions. However, the slight decline in occupancy and move in rates, despite an increase in in-place rates, could signal a maturing market or increased competition. We've seen companies like Extra Space Storage and Public Storage in this space. And competition can indeed drive down new customer pricing. A key concern for any REIT is its ability to maintain strong occupancy and rental rates consistently, as this directly impacts their revenue and ability to pay dividends. The historical context here shows that self-storage has been a resilient sector, but even resilient sectors face headwinds. For example, when the broader economic outlook weakens, people might move to smaller homes, reducing the need for extra storage, or they might be more price sensitive, opting for cheaper units or even consolidating their storage needs. What I'm actually looking for is to see if these trends continue in the next couple of quarters. If these occupancy and move in rate declines persist, it could signal a more significant shift in the market. The increase in in-place rates is positive, but it can only offset so much. My biggest concern is the trend in move in rates, as this is the lifeblood for attracting new business. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.